So the best way that I can simplify the infinite banking strategy is like getting a reverse mortgage on your home, right? So the cash surrender value, think of that as equity in your policy, and you could borrow against that equity within the policy. So where some people misunderstand the infinite banking solution is or strategy is they think that you're borrowing against your death benefit. You're not borrowing against your death benefit. You're borrowing against the cash surrender value that's built up within the policy. So is that a valid strategy? What do we like about reverse mortgages? And are reverse mortgages for everybody? No, absolutely not. But if you're in a situation where you need to tap in your equity, you don't want to move out of your home, you could borrow against the equity from your home and it's tax-free. Right? So with the infinite banking strategy, same thing. You can build up these reserves over a period of time. Now, I will caution people, this isn't something that happens within 2 or 3 years. It takes time for those reserves to build up. Now,
wake up, it's time to rise. Talking money with sharp insight. Jim and Ryan here to guide. Mastering the money ride. Saving stacks and planning dreams. Living large by honest means. Tune in now for the schemes, breaking down financial themes. Money mindset every day, mastering.
Well, I'd like to welcome everyone to the Money Mindset Mastery podcast. I'm your host, Jim, and joining me today, as always, is my co-host, Ryan. Ryan, how are things today?
Great, because I found out on March the 8th, the sun will set at 7:37. And that is amazing news that the sun will be out much later than we've had in quite some time. So
Really?
yes.
Wow. That's exciting. Now, is that because there's going to be a time change as well, or is that without the time change?
Oh, is there a time change? I did not know that.
Well,
So,
you spring forward, fall back. So I'm wondering if maybe we're springing forward sometime soon. So, anyways, it's all good news. We'll take it.
Yeah,
we'll take it. Yeah. Well, that's going to brighten up a topic that we have today because we're going to be talking about a very exciting topic of the difference between term insurance and permanent insurance. And the reason why we're having this conversation, Ryan, you and I have both recently had a lot of clients come to us and say, hey, I've heard about this infinite banking concept and I really want to find out more about it. It sounds fantastic. So we're going to touch on that because a lot of people are getting their information from American social media individuals. Yep. And what I will say is it is a valid strategy in Canada, but it doesn't work quite as well as it does for Americans and American insurance policies. But again, we'll touch on that. But I thought before we do that, we should probably explain the difference between term insurance and permanent insurance because we also do get that question asked when we're meeting with clients presenting an insurance solution.
Yeah,
right.
Absolutely.
So I think the simplest way there's term insurance and then there's two forms of permanent insurance, and we're going to kind of break those down as well. What I typically do in explaining the difference between the two, term and permanent, to simplify it, maybe oversimplify it, is term insurance is you're renting the coverage. It's really for temporary needs, for large needs. I would say it's similar to if you were to rent an apartment or a condo. It's going to be cheaper to rent that apartment or condo. But after a few years of living there, you've paid all that money. You were given shelter, which is what you needed. And then if you decided to move on from there, you're not really getting anything back, right? Or permanent insurance is almost like owning your home. It costs more, but you do build equity, and typically it's there for the long haul. So if you decide to get out of it, there could be something coming back to you. How do you typically explain the difference between the two?
It's kind of very similar. Term insurance is like renting your home, and permanent insurance is like owning the home is essentially it. The term insurance is a temporary solution. As we talked about, term insurance typically will be much cheaper than whole life or permanent insurance. And it's because it often has a specific goal wrapped around it. You have a specific need, so you can get more coverage for much cheaper than it would cost when it comes to permanent. And again, as you said, is it accumulates cash value or what did you call it? Like equity in your
Yeah.
home when you put money into it. So,
Yeah.
and it's yours to own. That's kind of it. The temporary insurance is essentially not yours. It will eventually end at a certain time period unless you renew it. But the the other side, the permanent insurance, is your ability to own something and use it as a strategy. And we've had people use it as a strategy for retirement, for putting their kids through university, for putting down payment on a home, for that matter. It all depends on how you use it and how when you got it. Lots of factors come into play, and I think that's part of when we walk people through kind of their plan and their specific goals. It's when we start having that discussion where to keep a balance. Often, I would say, most of the time, people start off with some sort of term insurance and move towards, depending on, I guess, the transition of their life and their goals, to move towards more permanent insurance and how that helps them.
Yeah. And I think what I want people to understand here is there are individuals who present these products as one size fits all solution, either with the term insurance, or you'll hear advisors say, no, just buy term and invest the difference. That's the only way and that's the best way. And you'll have other advisors who'll say, don't ever buy term insurance, just put all your money into whole life insurance and you can do all these other things, like the infinite banking strategy. And that's not always the case. Like one size does not really fit all. It really is, we have to break it down to the individual's needs and their long-term goals, right? And I know you had said something, and I catch myself saying it as well, that term insurance is cheaper than permanent insurance. But is it really cheaper? Right? Because if you think about it, you pay into something and potentially there's never a payout from it. So, statistically speaking, in Canada, term insurance policies, less than 2% of those policies actually get paid out, or there's a claim made on those policies, because a couple of things will happen. Either with term insurance, there's typically an expiration date. It could be based on, usually it's based on age. So some companies are 65, could be up to age 85, for example. So theoretically, you can pay into this policy all the way through, and then it expires, and the next day you pass away, and there's nothing that gets paid out. Right. So that's pretty expensive with that type of product. With permanent insurance, as we mentioned, we talked about there's potential of cash savings or cash surrender value that builds up. So after so many years, if you decide that you no longer want the coverage, you can get refunded a bunch of your money back. And in a lot of cases, when you look at the cost between the two, the fact that you're getting some money back with the permanent, it's actually cheaper long term to have permanent insurance, right? The other reason why with term insurance that there's only a 2% claims ratio on it is because they're typically structured where after a period of time, there's a significant increase in premium or cost. And most people will deal with that, even though you and I warned them, right, Ryan? Like we warned them that this is going to happen. For whatever reason, they're like, no, I'm not gonna. That's not going to be me. And then life changes, and they do need the coverage, and now they're dealing with some significant increases. So some of them will just cancel the policy because they just can't afford to continue on with that policy. Are we going to say something?
Well, again, going back to correct myself, is I guess term insurance is great for a short term big gain when you're young, but as you age, it will eventually become much more expensive.
Well, give an example. Like what would be a short term need where you would require term insurance?
A mortgage is a great example. Is if somebody has a mortgage, a 20-year, 25-year term for the mortgage, so that makes sure. And again, we talked about on our last podcast, making sure that pop quiz for anybody listening. Go back and listen to the last one about mortgage insurance, what the effects of that are in comparison to having your own insurance. But yeah, a short term need is often getting a lot of. I find families getting over that first few hump of whether it's mortgage or just in case if your kids need to go to school. That's helping them within our needs analysis. But again, as you said, we do these yearly reviews to review people's insurance. And if you haven't done the yearly review with your advisor, call us. We'll happily do a review with you to understand, does this term insurance now meet your need, even if you're a
Yeah.
couple of years into it. And
Yeah.
then obviously we'll talk a little bit more about that transition of when do I convert? Is
Hmm.
it part of my goal or strategy to convert? We have these conversations with clients often is before that 10-year term or potentially 20-year term. We look at seeing, based on your age, if you're, especially for those people that are in great health, there might be some value in going and either getting a new policy or converting a portion of that policy and using. And again, we will start tackling a little bit about the when is the right term to convert and who are potential candidates that want to look at converting some of their insurance. But going back, I think every person every person is different. Every strategy is different, and things change so quickly. That's why we do at least a minimum a yearly review. A lot of our clients sometimes even get 2 reviews a year, and it's how engaged are you in this process? People get married, people have kids, people move jobs, things like that. So
Yeah. Well, we go through a needs analysis too. I think we should talk about that a little bit because I know in speaking with clients when we talk about life insurance coverage, typically they'll say to me, "Well, I only need X amount of dollars because that'll cover my mortgage and it'll cover some of my debt." What they don't really take into account is, well, what if your spouse, for example, is the main income earner and the family loses that income? How's the family going to survive? Right? So one way is you need to have a lump sum of money set aside that you can draw from, and some people will require that for a year, 2 years, 5 years. Some of them will say, "Hey, for lifetime, don't want to have to worry about having to get a job or whatever else." So we go through a proper needs analysis first to determine what is the appropriate amount of coverage. So we're going to look at things like your debt, final expenses. Like it's a lot of people don't know what it costs to bury an individual. Right now, we're looking at a range of twelve to $20,000 for nothing too fancy. Right? You have to worry about your final tax return because the government's going to want their money sooner rather than later, and things like putting money aside for emergency reasons. What if the roof starts to leak? What if the car breaks down? So we need to really identify what those gaps are and the actual impact to the family if the major income earner passes away prematurely. And that's why some of that is considered temporary, right? You said mortgage, could be some debt. The income part of it is, well, for example, if the kids are older and you're no longer responsible for taking care of them financially, well, maybe the income requirement drops as well, right? So those are the things we're definitely going to take into account when we walk through a needs analysis with a client. And a lot of times it scares them when we actually show them what they should have in terms of coverage. They'll come in with this number of call it 500,000, and then we're like, well, and actually to meet all these goals, you're going to need 2.8 million of coverage. They freak out for two reasons. First, they're thinking that's going to cost a lot, and secondly, they're like, that's a lot of coverage. Like I don't really know if I really need that much. And then when we show them again, here's a breakdown, here's how it all works, and that's where there's a place for term insurance. Young families who have this significant need to cover all these obligations in the event it's insurance, so it's in the event of a premature death. We need to have a significant amount set aside for a period of time. It would be very costly to do that all as permanent insurance. And that's where term insurance has its place. So again, I repeat, Ryan and I will never sit there and say, oh, one is better than the other, or you should stay away from the one over the other. It really is based on the circumstances, right?
yeah,
Because
absolutely.
term insurance is not going to work so well if you have an estate need because it's going to expire at some point, right? And that's where another product comes into play, which is the permanent insurance, right?
Yeah. And you can never be too sure how much you need until you go through the process. I would challenge anybody, especially any single parent that is a widower, if you haven't read up on it or if you know somebody in your life, ask them, would they have been better off if they had more insurance? Because the struggles that they face, and then when it comes to you push yourselves into retirement, what kind of lifestyle you want to live, and how to make sure that you maintain that kind of lifestyle, or that you hopefully potentially are leaving for yourselves. you're leaving something better for your legacy and your kids, right? So
Yeah. Yeah. So, in terms of permanent insurance, I mentioned there's really two types. There's or almost three actually. If you think of term to 100, which is a term insurance product which covers you all the way to age 100. The premium's locked in all the way through, so there's no increases that you have to worry about. But there's no cash value. There are some products that offer some sort of cash value after 20 years, for example, but most of them typically are there's no cash value. It's kind of like your cheapest option or least expensive option to have permanent insurance or permanent coverage, right? Then there is kind of like on top of that, there's what's called universal life insurance. So universal life insurance kind of plays with the concept of buy term and invest the difference. So it does have for example, a level cost of insurance component to it, which is usually term to 100. But then you can also add additional funds to it to help increase your death benefit. If you do base plus, it could help to build a portfolio where it would shelter that money from taxation, right? It could potentially protect funds from a collateralization point of view. There's a lot of benefits to the universal life product. However, most people, again, they invest in universal life. It's because they want to have some form of investment vehicle that's invested in the public markets like stocks or bonds. So there's index-based solutions within these programs. If they're not structured properly, though, I warn people because, again, you can control how much goes into those plans. So if your cost of insurance, for example, is $100 a month and you invest $100 or you put in $100, that's what all you pay, and your investment is an equity type of investment, and all of a sudden there's a market correction, you will be getting a letter from the insurance company saying, hey, the value of the investment went down. Either we're going to reduce your amount of coverage or you're going to have to make some form of top up. Right. So, really, where that scenario works well is if you do what's called overfunding the policy. So, if your base cost is 100, but you can put up to $500 a month into it, then you get closer to that $500. So, then you have that flexibility in the event of some volatility in the portfolio. Right. And then there's the good old fashioned whole life insurance that pays dividends, or we're expecting for those dividends to be paid every single year. And you can structure those dividends to work different ways. You can receive those dividends every year paid to you in cash. You can have it purchase additional insurance, what's called paid up additions, and have it reinvested. And again, there's a whole bunch of different options. The reason why we like that type of product is because there's no market risk there. So once you earn that dividend within the policy, you can't lose it. It's yours, right? So maybe you want to expand a little bit more on whole life insurance and what we like about it.
again, we talked a little bit about the lifetime coverage, the cash value that accumulates, and that's what you just talked about is that dividend, that ability. Again, especially when it comes to investing, people are always quick to invest into the market, but this is our way of being able to accumulate dividends in a tax efficient way. Um, and then again, talk tax advantages. I'm not a tax specialist, so I'm not going to speak much to the tax advantages, but we would obviously bring in tax specialists on that to how to really help you build that, especially for your next generation or legacy. Something else we didn't that I was going to mention before too is the ability for some people to use um, this as a way of investing in their future and help it grow even further. And again, as you just said, it allows the protection really that you're invested in it and that you own this versus the term insurance. So it really changes the way people think about insurance because it's an insurance strategy for whatever their goal or need is. And it really helps with people's estate planning, I think, is one of the big things that people don't really consider when it comes to some sort of permanent insurance is the value of using this tool within estate planning and providing liquidity for your heirs. So,
Mm-hmm. Yeah, and before all you investment professionals kind of reach out at us and start saying this is not a great investment product, we're not saying it's a great investment product. We're saying it should be part of the asset mix, right? So out of the fixed income portion, the set it and forget it, the with guaranteed cash values and the tax sheltered growth, it should be part of the solution. It shouldn't be the solution, right? And I think on that point, what I will say to people, if you are looking at getting advice on if you should have term insurance, whole life insurance, any type of insurance, be mindful of who's giving you the advice. So if your trusted advisor is someone who all they do is mutual funds or all they do is offer stocks and bonds and they don't offer insurance, chances are they're going to say to you, you don't need all that coverage or that type of coverage. We're just going to invest it for you and we're going to make all these wonderful projections and here's what the projected outcome is going to be. On the flip side, if you're dealing with an insurance only advisor, they're probably going to say to you, yeah, let's put all the money into an insurance based solution. So let's put it all here, get away from the markets because they're really risky. And here's why this is so much better, right? Again, Ryan and I stress there's a place for both. So if you do want advice and recommendations on if you should have it or not have it, the type of product and how much you should have and whatever else, speak to an advisor who is duly licensed, who offers investments outside of the life insurance offerings, but also offers insurance solutions because that's the closest you're going to get to an unbiased recommendation. Or even if you're dealing with a certified financial planner who doesn't sell product, right? They're going to also do that assessment. So if you want to pay for that plan, they will make that recommendation, and there won't be any biases there. So that's really my recommendation at this point in looking at insurance. So now let's talk about the infinite banking strategy. And we're not here to sell it, saying that you should have it or shouldn't have it. We're talking about it right now because we're seeing this a lot on TikTok and on Instagram, YouTube for that matter as well. And I do have clients asking me about the infinite banking solution. So do you want to talk a little bit about what that concept is, Ryan? Do you have an understanding of it?
Well, I have a basic understanding, but often bring in because it's specific to a person or a business owner's needs, and that's where it comes in, and that's why I bring in specialists for this all the time. I bring yourself, we bring other specialists like Dave, and some other partners that we have to really talk about how certain individuals can really take advantage of this infinite banking or becoming your own bank is essentially what it comes down to. Again, I'm sure lots of people have seen this, the TikTok or the Instagram videos that say, toss all your money into some sort of whole life insurance product. And essentially, if you need money, you can draw from that. And there are different ways you can do that, whether it's taking a portion of the cash value. And again, you have to have a tax expert there to make sure that you're not over withdrawing, because then there becomes tax problems. And or you could potentially take a loan out on the value. And
Mm.
there's companies that will allow leverage or lending towards the cash policy as a whole, up to a certain point. And again, when it's the right situation, that's when I start saying, okay, let's start bringing in some more experts to just talk about the specifics about how it can benefit a business owner, a small business owner, or a family trying to create perhaps maybe some generational wealth for that
Mm.
matter. So
Yeah.
that's, I guess, kind of skimming along the top as to like a basic understanding for it,
Yeah.
without getting into the nitty gritty, because that I don't want to lead anybody down a wrong path to say,
Yeah.
oh, well, that's what I want to do.
Yeah.
We have to really look and dig deep into understanding all of your goals, all of the outcomes that you want to happen
Yeah.
before I would even dig into it anymore. I don't know if there's something else that you wanted to add yourself. So,
Well, to kind of, again, I like to simplify these things. So the best way that I can simplify the infinite banking strategy is like getting a reverse mortgage on your home, right? So the cash surrender value, think of that as equity in your policy, and you could borrow against that equity within the policy. So where some people misunderstand the infinite banking solution is or strategy is they think that you're borrowing against your death benefit. You're not borrowing against your death benefit. You're borrowing against the cash surrender value that's built up within the policy, right? So is that a valid strategy? What do we like about reverse mortgages? And are reverse mortgages for everybody? No, absolutely not. But if you're in a situation where you need to tap in your equity, you don't want to move out of your home, you could borrow against the equity from your home and it's tax free, right? So with the infinite banking strategy, same thing. You can build up these reserves over a period of time. Now, I will caution people, this isn't something that happens within 2 or 3 years. It takes time for those reserves to build up. Now, American-based insurance policies tend to build up quicker than Canadian policies, but that's part of the concept. Okay. So then you reach a certain point, and all of a sudden you need to buy a vehicle or put a down payment on a home or invest or whatever else. What do? You could borrow against the cash value in your policy. Again, valid strategy. We have no issues with that. What I would say is the biggest difference between American based policies and a lot of the people who are marketing the strategy compared to Canadian, which is still valid, is when you take a policy loan on an American life insurance policy, there is no tax, regardless on what your contributions were and what cash you're actually borrowing from the policy. In Canada and Canadian policies, that's not true. So, for example, if you have if the cost for your insurance has been, call it $30,000, and you have 30,000 cash that you're going to borrow, so you're going to take a policy loan on $30,000. There's no tax on that. However, if your cost was 30,000, but you're taking a policy loan on 50,000, so $20,000 more than what you've actually paid for the coverage, there is going to be a taxable event triggered, even on a policy loan with a Canadian policy, on that $20,000 difference, right? So that's the biggest difference from Canadian policies and American policies. So then, with some Canadian advisors, what they'll say is, well, you can collateralize the cash surrender value. They're absolutely right. Problem is, now you're not your own banker in that situation because now you actually have to go to a bank and request for a line of credit to be collateralized against your insurance policy, the cash surrender value. Now, it might be lighter or soft underwriting, but what I will tell you is there is financial underwriting. Some of it, again, depending on the amount you're borrowing and the financial institution, it might just be based on your credit history. Some will be credit history plus income and assets verification, right? So now that defeats the purpose of becoming your own banker because you have to go to a bank to actually get the line of credit to be collateralized against a policy, right? So we're not here saying that it's not valid. If you're a Canadian, you shouldn't do it. It is. Just understand the differences between the two, right? Between the American-based strategy and the Canadian-based strategy, right? And we do offer this as a solution. I think the other one too is where advisors again think that or present it as this is great for everybody and it's a one size solution fits all. If you're only going to put $100 a month into a whole life policy, it's really not going to work. It's really not going to do much for you unless you're started when you're 5 years old, right? It's a juvenile policy and you've accumulated over 30, 40, 50 years, right? I would say at $500 a month, if you, again, doing that for 20, 30, 40 years, sure. But really, where it becomes meaningful, if you're putting in $25,000 minimum per year into these policies and you have a 10 or 15-year time horizon, that would work reasonably well, right? I do have clients who put thousands, hundreds of thousands of dollars into these policies, different client class, different tax situation, different tax bracket. But I also do have clients who put in less. Again, we're stressing it is based on your situation.
Yep.
Right.
Yeah.
So
I got nothing else to add for that because you hit everything on the head when it comes to the strategies and how different places work for different people. More or less, right now, what I'm seeing is a lot of grandparents starting to buy for their grandchildren or great grandchildren, for that matter.
So why?
And,
why would you think that is?
well, one, the cost of insurance is cheaper when you're younger. Two, they're trying
and you
to
lock it in, right? So that's
you're
the thing.
locking it.
Yeah. So if you buy whole life insurance, for example, at age 15 or age 10, whatever that premium is, call it $50, $80, $100, that's locked in. It'll never be higher than that, right? So I think
Yep.
that's important to stress.
Yep.
If you bought the same coverage and you're 50 years old, it's not going to be $80 a month, right? You're probably looking more like $400 a month, $500 a month.
Yep.
So we really need to stress that.
And I think again, it's allowing them to pass on their money as like a gift for the next generation, and allow them to accumulate some wealth, hopefully over time, because we get people who create 10 pays and well, we've seen 8 pays more recently, 10 pay and 20 pay, meaning you pay into it for 8 years, 10 years, or 20 years, and once it's all paid in, and that they structure that they're able to overfund which allows them, or I guess their grandchildren, the future of to access it for car loan or education or a down payment on a home. And that's what I'm seeing, because this is our grandparents are the wealth generation that large big bulk is going to pass on to, and they just want to use it as kind of a helping hand for the next generation. So
Yeah. Yeah, it's a great way to pass some wealth. It's great for legacy planning, right? So there are a lot of benefits if placed for the right reasons, right? But what I will say is this: like when I do speak with clients that are in their 70s, and I ask from a financial point of view, what is their biggest regret, financially speaking? And every single time the response has been, I wish I had either more insurance or I had whole life insurance and I canceled it, because a friend suggested I didn't need it or it was a waste of money or whatever else. And now I wish I had it because it makes things so much easier, financially speaking, for my family when I pass away. Because now I've got this tax problem because of my cottage. And when I die, that's going to trigger a taxable event and on and on and on, right? So they don't ever come back and say, I missed out on a great investment opportunity, or I didn't do enough RSPs, or any of those things. It's always been, I wish I had more coverage. I wish I would have known, right? And that's the thing is, when we give people advice, I always remind them, we're giving people advice based on the fact that we work with clients who are in those age brackets dealing with these challenges, right? So it's difficult for someone that we're working with to kind of project out 20, 30, 40 years on what things might look like for them. That's why you speak with us, because we are working with those people in those situations. We can anticipate what's going to happen based on
yeah,
our experience, right?
yeah. There's something I want to bring up, but I know it's probably worth a full other podcast for, which we've
So,
talked about. Oh, which was for those people looking to surrender their insurance policies and how to be able to pass it on to perhaps give it a charity. My brain stopped there for a second.
yeah, there is an option where if you decide to cancel your term insurance, depending on your health situation, or if you have permanent insurance, there is a way that it can be signed for charitable reasons. I don't really want to get too
That's why
involved in that conversation right now, because it does require a
professional.
specialized professional
Yeah.
who's kind of structured this program. So what I would say is, if you're someone who's older, has term insurance, and you decide that you're going to cancel it, reach out to us and we'll see if this is an opportunity for you. It's not for everybody. Again, it's not appropriate. Not everyone qualifies for this program, but it is an option. So I'm glad you mentioned it. But yeah, I don't really want to get too deep into the weeds on this one, because we'd rather bring in someone who specializes in this program. All right. But there are so many other strategies and benefits in having permanent insurance. But I think what I want to talk about next is, we talked about conversion. What does that mean? Right. So you can start off with term insurance. And if you decide at a future date that you do want to keep some permanent or whole life insurance, most companies and all the companies that you and I choose to work with have what's called a guaranteed conversion privilege, which means that you can take a certain amount of your term insurance and convert it or change it to a permanent. So it's almost like a rent to own, right? With when you rent a place.
Yeah.
However, whatever you've paid in term insurance premiums, that doesn't get credited to the whole life insurance, but it does give you that option, and you can do it regardless of your health. So I've had clients who've developed all of a sudden some serious health issue where they think that their life expectancy may be impacted, but they believe that they'll probably outlive the term renewal, but still have a need for insurance. They will look at converting the policy into something more permanent, right? So that's what a conversion option is. Some companies are offering what's called a switch option too. I don't think everyone does, but for example, if you buy a 10-year term policy, some companies give you up to the first 5 years. There's two that I know of that will go up to the first 7 years now. That if you decided to change your mind, meaning, yeah, I think I need it for another 15 years or an extra 20 years, you can go back to the insurance company without having to prove medical or anything like that and just say, hey, I've changed my mind. I do want this for 15 more years now, or 20 years, or whatever the term is. And we can process that switch at a higher premium because it'll be based on the age that you trigger it, but it is an option. So sometimes when people are trying to figure out, they have this insurance need, a significant insurance need, they really like the permanent insurance. Maybe they don't want to get the permanent now, or maybe they quite haven't landed on the length of term they should have for their term insurance. We say, well, at the very least, start off with a 10 and let's make a decision within the next 5 or 7 years. Because if you start off with permanent insurance and you've decided it's too expensive, I can't afford it, and I want to have term insurance now, you can't convert back into term. You'd have to cancel and apply for new coverage, which you may not qualify for. Similar with the term switch option. If you did a 20-year term, but then 5 years in you decided to change it to a 10-year term, you can't switch back. It has to be to a longer term, right? So usually we'll say, then let's start off with 10, and that gives us that flexibility to switch up or convert to a better solution,
Yeah.
right?
Yeah. And going back to the converting piece too is obviously understanding some companies will have a time frame in which you're doing it, and we always say, well, I always say often it's sooner rather than later to avoid those higher premiums at an older age, and obviously, I've spent the last year and a half chasing people. I hate to say chasing people because we want to be on top. We want to be on top of people before their term insurance. I'm very aware of the shocking feeling people get when they get a letter in the mail from the insurance company that says your $80 a month premium is now going up to $3,200. I don't want to say chase because that's sometimes when we make the calls, because we want to share that information with them. Is there are strategies to make sure that we're doing these things before. That's why we have a team.
We're being proactive. You're not chasing. We're being proactive.
Yeah. So great recovery for that too. So is that we want to be proactive when it comes. That's why it's important for us to do yearly reviews with clients too, that we maintain their information up to date if they decide to, they're moving to an island. I don't know why they didn't call us to say they're moving to an island to invite us, but
do they have a place for us?
Yeah, exactly. So, and then of course, as you just said, like making sure that they're hitting, if they choose to decide that they're finding that window for the conversion before it expires, because it's not there all the time. And again, goes back to the premiums. You're that much older, and the premiums are going to be that much more potentially unaffordable for somebody. So, that's why we look at everybody and try to do these reviews as often as possible. And as I've said on many podcasts before, make us part of your top 5 list. When something major changes, how does that impact the rest of your plan down the road? So,
yeah. Well, it's funny because I've dealt with many of these types of situations, but one recently that I've been dealing with that really hits home when it comes to this whole conversion or switching option or being proactive. But one of the assumptions that people make is that, well, I'll just get new coverage and automatically going to get it. It's like, no, health changes. So if you can't switch, if that's not an option and you don't convert and you're just simply looking at getting the same type of coverage, but you don't want to deal with that renewal, which can be significant. So sometimes what we'll do is we'll put in place new insurance, which is generally cheaper than what the renewal amount's going to be. But people assume that they're going to be healthy and qualify automatically, and that's not the case. That's why we usually start about 2 years in advance, sometimes 3, but usually 2 years. We like to do it no later than 12 months before the conversion or the renewal, because it's like we have to go through underwriting, and you may not qualify, and that changes the situation as well. So I have one. I'm not going to be naming names or anything like that because I don't want to offend or upset anybody. But I'm dealing with a situation right now with a couple, really lovely couple that I've been working with for over 10 years now. They're older. They had a need for a significant amount of insurance coverage. They wanted the cheapest solution, right? And by cheapest, they meant premium. So we did a 10-year term. And I asked them, I'm like, are you going to need this coverage beyond the next 10 years? No, probably not. Are you absolutely sure? No, probably won't need it. Well, a few years in, and this is before the switch option was available. Okay. So a few years in, started working with, I presented to them, maybe we should convert some of this. It'd be a lot cheaper to convert now than to wait for the renewal. And they're like, hey, yeah, we like it, we like it. And then they just kind of dropped it. And then a couple of years ago, I can see that there's this renewal. We're going to go from $500 a month to $3,000 a month. Um, Requoted a lot lower premium, and they're like, no, we're gonna hold off. But I asked them, I said, do you think you're going to need this coverage beyond the next 2 years? And they said, well, we don't know, maybe. Well, guess what? They got that renewal notice, like you said, and they saw that it was going to go from $500 a month to $3,000 a month. And usually the insurance company sends that notice about 45 days to 60 days before the renewal. Now, when you're in your 20s or 30s, you have a better chance of qualifying for new coverage. Chances are you'll qualify without a rating or a health issue. These clients were in their 60s and 70s. So when we finally started the process, we really didn't have a whole lot of time. Well, guess what happened? First of all, if it was a standard rating, meaning that they're both medically cleared, no issues whatsoever, their new monthly premium, because they then decided that they needed to maintain the same level of coverage that we've had all along, even though at first they thought they probably didn't need it after 10 years. Well, it was going to go to $1,300 a month if we put in a new insurance policy, which is better than the $3,000 that it was going to go to. Went through medical underwriting. There was a rating on one of the two, which meant that the premium is actually $1,800 a month. Still better than the three, right? But a lot more than what they had been paying for the last 10 years. So then they came back and said, well, maybe we should cut our policy by a third. Well, I'm like, okay, we can do that. Here's the thing. You can cut your existing policy by a third. That means the premium will be instead of $3,000, will be $1,000 a month. The new policy with the rating is still $800. It's still significant, right? So finally they landed on, well, we need this coverage. We need the full coverage. And we don't have much of a choice. Like we got down to like 30 days before they needed to make a decision. And they're like, we just, we don't have a choice. We have to move forward with the new policy at the $1,800 a month. All of that could have been avoided. I tried to help them avoid all that by reaching out to them many times throughout the 10 years, having them look at different options. But again, I don't blame them in the sense of they can't anticipate those things. But me, who's been doing this for a long time, I've dealt with clients in those situations. I anticipated that there was probably going to be this need for this coverage beyond the 10 years. They just wouldn't go ahead with the recommendation. So now a bit of a gun to their head, and they had to go through with the current offering, right? So All I can say is please listen to us when we make these recommendations. I'm not saying that we're right all the time. It's insurance. So you may need it. You may have to claim on it. Hopefully you don't, right? But please listen to our recommendations. Take them seriously, and don't delay them. Like if at the end of the day it just doesn't fit, it doesn't fit. But we are dealing with clients in the situations that you're anticipating, trying to plan for, but don't really have a full understanding. I think the other clients that do kind of follow through with some of those recommendations are the ones who've like, yeah, I've dealt with this with my mom or my dad, and I've seen the impact of not having coverage. So they're the ones that kind of come in and they're um, more willing to take our recommendations because they've experienced it with a family member,
Yeah.
right?
That
So
that is
yeah,
the unfortunate part of our job, is that the experience, we have the stories of all the unfortunate times, right? So that's why we kind of try to act with a sense of urgency when it comes to really helping people in planning. So, obviously, don't take your advice from TikTok and things like that. To take it with a grain of salt, find a couple different sources, especially a professional. Hopefully, you find a professional like us to talk through what your ultimate goal is and what are potential outcomes that you could expect. Uh, Unfortunately, that's sometimes part of the doom and gloom conversation that you have to have with people. But we're trying to prepare you for the worst and with the best outcome. So
yeah. Listen, we understand that no one wakes up in the morning and the first thought in their mind is, I wonder if I have enough coverage today, right? It's no one thinks about that. It's up to us to have that conversation like we do. So when we walk through when we're dealing with a new client, we prefer to walk them through a full financial plan, because part of the plan is we identify if there's an insurance gap or shortfall, right? So our preference is to walk clients through. But another reason why, again, a client will come to us is if they have a close friend or family member who passes away. I know I've been to funerals, and unfortunately, and I would hear people kind of talk who didn't know what I did for a living. And I would overhear them say, I wonder if that person had enough insurance. Like, what are they going to do financially? And all of a sudden, I see a GoFundMe page pop up because they didn't plan for a premature death. No one wants to think that way, but that's why it's insurance. It's just in case, right? So what I would encourage people to do, if you don't want to talk to Ryan and I, but you'd like to get a sense of if you do have enough coverage, if you want to get a sense of pricing, I'll direct you to our website at tvhfinancial.ca. We do have a page. If you go under the insurance services, there is a tool there that you can actually quickly do your own basic needs assessment to determine how much coverage you should have. And then if you decide you want to get pricing on some coverage, you can also get that pricing on our website as well. Or you can just reach out to Ryan and I, and we'd be more than happy to spend an hour to walk you through the process to, again, determine if you do have enough coverage and even do an assessment of your existing coverage. Because here's the thing, I've had clients come to me who have bought insurance from some of those direct providers, right? And you know why they're cheap or cheaper is because they don't have all the bells and whistles. Where some people say, I don't need those bells and whistles. They say that until they need the bells and whistles, and then it's not there, right? So you kind of get what you pay for. I think the other benefit in working with advisors like Ryan and I is we also have an understanding. For example, if you're someone who has diabetes, from an underwriting point of view, we know who might be better at underwriting a diabetic. So we can navigate you through that situation. The other thing that we also know is if you decide you want to convert your term insurance, I know I've had people say, I'm probably not going to do it, and then they change their mind years later. I prefer to place them with insurance companies that have strong options to convert into. So that's another important point. I think finally, and unfortunately, I've been dealing with this personally with a recent claim, knowing how insurance companies handle claims. And with Ryan and I having experience with the claims process with different carriers, Sometimes we will avoid certain insurance companies because the claims experience has been unfavorable. Not that they're not paying out the benefit, but they make it very difficult to claim. Right? That's the last thing you want to deal with when you're dealing with, the loss of a loved one. So we'd be able to help you navigate through those situations. Right? Any final thoughts or comments before we shut her down?
No, I think it comes down to just make sure you're doing a yearly review with us. Don't hesitate to reach out and just make sure that your needs are being met. You're not paying for more insurance than you. I have had clients that have way too much insurance than what they actually need, and it's
I
about
agree.
reviewing that. And for us, it's the education piece about uncovering places where maybe we're freeing up cash for you to go in other areas to reach other goals, buying islands or going on vacations, or for you, Jim, getting a new car.
Yeah. Awesome. Well, listen, I'd like to thank everyone for watching and listening. Ryan, you as well for recording another episode. If people want to reach out to us, financial or tvhfinancial.ca, tvhgroup.ca, financial@tvhgroup.ca. If you want to email us, you can call us 647-727-4668 or find us on all the major social media platforms. And we ask and encourage you to like and share and subscribe. So that way we can get this information out to more people. We are receiving responses from clients who we know they're listening to our podcast because they're actually asking questions that they're getting from recent episodes that we've recorded. So keep on sharing, keep on, we'd appreciate it to promote our show because, again, that way we can help more people. So until next time, have a wonderful day. Take care.
Why is it me? Why am I a guy? I still buy low, still sell